Welcome back. We've been going over some good information these last couple weeks, and I want to keep that going. So what if I told you that you finance everything you buy? You either pay interest to somebody else or you give up the opportunity to earn interest on the money that you use to buy that thing or that service. That's what we're going to go through today. There is a better way to do this. What if I told you there was a better way that the banks don't want you to know about, that the credit card companies don't want you to know about, that the biggest financial institutions in the world don't want you to know about? And why doesn't your financial advisor tell you about this? The biggest part about financial planning is making sure that you don't lose opportunity costs. You don't lose the ability to earn interest on your money, but yet you're not being told these things. Make sure you like, comment, share, subscribe to this channel, watch this video, share it with your friends, and let's dig in and have a really good discussion about what we call the private reserve strategy. And this is going to lead us about a bunch of different rabbit holes. I'm not going to go there today, but in future videos, we will go into those rabbit holes and we will talk about all those things. Some transfers are avoidable. Others you can only minimize. And two key points you must understand before we move forward. Number one, you finance everything you buy. You either pay interest to another institution or to somebody else, or you give up the ability to earn interest. Number one, you have to understand that. That is an undeniable fact. You either pay interest to somebody else or you give up the opportunity to earn interest on that money. So it's costing you something when you buy something. It's a financed decision. Number two, every dollar that is not saved is consumed by transfers, wealth transfers, and lifestyle. Every dollar not saved is consumed. You have to understand that. And we can get into, the economic squeeze on capital, what that looks like, how does that really work, the external pressures of inflation, it erodes the purchasing power of your money. What cost $1 in 1980 costs a lot more today. It was $2.65 back in 2010. We're even further along than that now. Pressures of consumer debt, buying power when financing costs are allowed to compound consumes buying power and can quickly snowball out of control. And debt is the only purchasing option for large or unexpected expenditures when one person has no additional capital. So we're going to go through a bunch of this stuff. So stay with me. Here are a comprehensive list of capital transfers that create wealth transfer. And it's not wealth transfers for you, it's wealth transfer away from you, your mortgage, your qualified plans. I'm about to do a video on qualified plans. You're going to want to watch that. College funding. I'm about to do a video on college funding. You're going to want to watch that too. Taxes, protection, all of the different insurances you're supposed to get. Major capital purchases, credit cards, cars, buying down payments on homes. So what is it that you're supposed to do and how are you supposed to do this? So let's keep going a little bit further. Remember, like, comment, share, subscribe. The information only gets better. It doesn't get worse. So before any capital outlay, before you take money out of your wallet, write a check, pay for something, you must consider not only the cost, but also the opportunity cost. And it's not just what you pay, but it's how you pay for that item. And so I've done something similar to this before in the past. I want you to see it. So how would you like to pay for it? And we're going to stretch this out over a 10-year period of time. And we're going to say that you have an asset that's worth $30,000, left alone, compounding interest at 5%. It earns $19,000 at the end of a 10-year window for a total value of $49,000. As opposed to if you financed something for 5% over a 10-year window, you made a monthly payment of $318. At the end of those 120 months, not only would you have paid back the $30,000, but you would have paid interest of $8,000. So the difference between interest earned of $19,000 and interest paid of $8,000 is $11,000 differential. But you're being told debt is bad, pay cash. Had you paid cash for this item, you would have lost the opportunity to earn $19,000. But yet debt is bad. So don't borrow, pay cash, lose out on the opportunity cost of $19,000. This is a net differential, $19,000 of interest earned versus $8,000 of interest paid. It's a differential of $11,000. And if we extend that even longer, the differential gets even larger. But why are you being told debt is bad? Well, let's look at that. So you can either buy, borrow, or pay cash, right? So here's what happens when a debtor, they work to spend money. There's no savings, no earned interest. and they pay interest to other people. That's the debtor. The saver, and we've talked about this before, there's another video about spender, saver, wealth creator, but the saver saves just so they can avoid paying interest to somebody else, right? In that last example, they would have paid cash and they would have liquidated their account just to avoid paying the debt to somebody else. So they save, they earn interest on their money, then they pay cash. And then there's the wealth creator. They also save, but instead of draining their tank, they use other people's money to maximize the efficiency. They save, they compound interest, and they use their asset as a collateral for future purchases. I'll show you more about that here in a second. So not only does the debtor work to spend, but they borrow from a lender at high rates, and they use their future earnings as the collateral. So think of it like a credit card. So they let you charge a credit card, but you have to use your future cash flow to pay that credit card plus interest back. The saver, they borrow from themselves. They reduce their current collateral position and resets the compounding interest. And this is, people think this is the human nature way to go, the safe way to go. But then there's the wealth creator. The wealth creator borrows from a lender at negotiated rates, using their own money as collateral, and continue to earn interest and continue that compounding interest uninterrupted. As we go a little bit further, the debtor, they make payments to the lender at high market rates. The saver makes payments back to themselves, remember, because they drain their tank. So they have to build up their tank just so they can buy something else in the future. So they're making payments back to themselves to get back to where they were before they drained the tank for that major purchase, giving up the interest that they would have otherwise earned had they not drained the tank. That's the opportunity cost. And then there's the wealth creator. The wealth creator makes payments to a chosen lender. They have power to choose the lender, allowing their own money to earn interest compounding uninterrupted, maximizing the benefits in what we're going to call the private reserve account. Think about this wealth creator model for you. And it looks like this. Here's what the debtor looks like. They live on the zero line. They're paying interest to somebody else. Here's what the saver looks like. They live on the zero line. They're just paying themselves back, trying to build it back up. They've lost the interest that they would have otherwise earned. And then there's the line that does not live on zero, the wealth creator line. They're still making the same capital purchases the debtor and the saver is making. They're just using it in a different way. They're using their asset in a different way to continue to earn money on their money and not losing ground. Here's the problem with consumer debt, and we've talked about this. You borrow money and it's an obligation on your future earnings. You've got to pay it back. You lose capital to purchases and financing costs forever. Money's gone. It's not yours. It's theirs. Bye. Say bye. Bye to your money. And you're a debtor to the creditor, and you have loss of control of your money. Consumer debt is an inefficient purchasing strategy. The initial purchase is lost, as well as the interest owed, causing further loss that compound and spiral out of control. So pay cash is the option, right? Let's look at the pay cash option. It's not as good as what you think it is, right? To pay cash, first, you got to save the cash, and that takes time, right? How much time? I don't know, but every year you got to pay Uncle Sam what Uncle Sam is due, right? Because you have that annual tax leakage coming out of your account. But then let's say you finally build up enough. Then what do? Boom, drain the tank. I'll show you again. You finally built up enough to buy that thing. Then you got to drain the tank, and it kills the compounding interest. It's done. There's no more interest to be earned because there's no more cash. So then what you have to do is you have to start building it back up. You lose control and the interest you could have earned had you not drained the tank to make that purchase. So here's the true cost of paying cash, and no one showed this to you before. Emptying the tank resets the compounding cycle and shifts the growth curve to the right, causing a dramatic impact on future wealth. So let's look at it this way. You're contributing $5,000 a year to a savings account. You're earning 6% on that money. We're going to do this over a 30-year window of time. And we're going to drain the tank 5 times in 30 years. We're going to drain the tank. You're going to make a purchase that drains the tank 5 times. So you're doing $5,000 a year. You're going to build it for 4 years. So then we're going to make a purchase of around $25,000, and we're going to recycle this for 30 years. So here's what happens. If you left that $5,000 per year earning interest uninterrupted, it would grow to $424,000 at the end of 30 years. But because you delayed it and you built the tank up, depleted it, built the tank up, depleted it, built the tank up, depleted it, built the tank up, depleted it. And you did that 5 times. By the final time, you're in your 20th year to finally start building wealth for the future. And because you let that go, it only earns $74,000 of contributions plus interest, a total value at 6% of $74,000. That's a $349,000 differential over the long term. Can you see the power or the impact that making a cash payment, reducing the value of what you got, can have an impact over a long term? So what happens, right? What if you could make the purchases without emptying your tank? It's a good question. And if you're not using your money to make those purchases, whose money are you using? Well, if you could make the purchases without emptying your tank, this would allow your private capital reserve to continue to employ the benefits of compounding interest uninterrupted. And if you're not using your money, whose money are you using? You're going to collateralize a loan from a financial institution, giving you power and control secured by your private reserve strategy. Let me kind of show you what that looks like. So over here, you have your savings, your private reserve built up. Over here on the right, you've got the things, the major capital purchases that you want to make, whether it's a car, education for your family, wedding for your children, and then there's others that we can get into. But what we're going to insert in the middle of it is a financial institution. And so you're going to collateralize your private reserve strategy against the financial institution, and they're going to then let you use their money. This allows you to then make payments back to the financial institution, but you got use and control of the thing that you wanted, and your asset continues to grow uninterrupted compounding interest. This is the way wealthy people make money work, but there's a better way to do this than going directly to the financial institution. The power of this strategy is that you can continue to earn compound interest on the collateralized funds, but there's a better way to do it. The amount you have in your private reserve account can be collateralized. And there's really 3 things that you can do to increase the collateral capacity. One is you can contribute more money, keep growing the value of your private reserve strategy, even though it has collateral against it. 2, it earns interest. It has competitive rates of growth inside of it. It continues to earn interest and grows. Not only are you contributing, but it's earning interest to grow. And the 3rd is to pay down the lien, reduce the lien. And that gives you increased collateral capacity to make future capital purchases for other assets down the road. So here would be the ideal characteristics of this private reserve account. Stay with me on this. We've been through this before. Tax-deferred growth, you know you want it. Tax-free distributions, you know you need it. Competitive returns, high contribution limits, potentially deductible if allowable, right? Collateralized opportunities, safe, guaranteed no loss provisions, guaranteed loan provisions, unstructured loan payments back to the financial institution, liquidity, use, and control of your money, plus all of the other additional benefits you can get from this. Who wouldn't want all of these except the deductible contributions? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 of the 12 characteristics can be yours if you reach out to me and call me, right? So while many accounts work as a private reserve, there are some that work better than others. And let's look at these characteristics. So let's go through it one by one. So of all of those 12 that I just went through with you, and we want 11 out of the 12, how many does the 401k qualified plan have? 1, 2, 3, 4. 4 out of 12. CD, a certificate of deposit. 1, 2, 3, 4 out of 12. It's a different 4, but it's still only 4 out of 12. What if you use your brokerage account, your stock portfolio, you try to use that as a collateralized opportunity? 1, 2, 3, 4, 5. Okay, we got 5 out of 12. What about if we use real estate, home equity line of credit against real estate, or a line of credit against real estate? Only 2 out of the 12. Okay, what about a savings account or money market? 1, 2, 3, 4, 5 out of the 12. But let's go to the thing nobody wants to talk about, cash value life insurance. 11 out of the 12 characteristics of what you're looking for from a private reserve standpoint meets the criteria. And I've been through this before. I'm not going to go through it now. The 10-minute lesson on life insurance, the unlimited ways of product design inside of there. Check that video out. I'll put a link to it right here. Go back and look at that, because if you're not being told about life insurance as a tool for creating a private reserve strategy for your finances, for all of the major capital purchases that you're going to make in your lifetime, I don't care where you are in your life cycle, then you have to question the advice that you're getting. Why are you not being told about it? Why are you not being educated about it? If they tell you life insurance is bad, are they lazy, ignorant, or greedy? I did a video on that too. Let's check that one out right here. But what if we exchange the financial institution for a life insurance company, and we exchange the private reserve account for a policy's cash value? What changes in this private reserve strategy? Well, you can still use your cash value as collateral for a future purchase, but now instead of the bank wanting interest plus principal repayments, the life insurance company is willing to accept an interest-only repayment, which gives you the ability to make non-structured loan payments back, which gives you more use and control of your money. So cash value life insurance, when designed properly and utilized properly, can provide a stable growth, cash value collateralization, guaranteed loan access, no annual tax leakage on the growth, and tax-free death benefits, as well as all of the additional benefits and features that are available with additional policy riders. Why are you not being told about this? You have to question the source of the advice. And here's how we increase the efficiency. We enhance the efficiency of your private reserve strategy. So yes, you've got those unstructured loan payments, but you make accelerated principal and interest payments back to yourself, back to increase the collateralized capacity of your private reserve strategy, which then gives you additional tanks to fill for future capital purchases. And now you can make big capital purchases. You can make business purchases. You can make real estate purchases. You can make investment opportunity purchases, because you've built up all of these private reserve tanks. And now you have liquidity, use, and control of your money, unstructured loan payments, and the ability to pay it back when you want, how you want, at your pace. The private reserve strategy. Like, comment, share, subscribe. Let's dig in. If you question this, let's have a comment on this. Let's have a dialogue about this. If you're not getting this advice, you have to question why. Reach out to me. I can help. Click the link in the bio. Let's have a discussion. Talk to you soon.